JJ the CPA here. We're going to talk about the new law as it relates to like-kind exchanges. And under the new law, here's the big thing. It is only now allowed on real property, as in real estate. So no longer are you allowed to trade in your vehicle and it be a tax-free transaction. You can trade in your vehicle all day long, but in terms of it being a like-kind exchange that would kick the can on the tax ramification, no longer available. The law basically says on any tangible assets, there is no longer available the like-kind exchange. Now there is an expiration to that. It ends at the end of 2025. But between now and then, you're in a circumstance that in the past, if you traded in a vehicle, if you traded in machinery, if you traded in an airplane, right, you could put yourself in a situation where that event was not taxable because it was done as a like-kind exchange. Like-kind exchange being that you exchanged a similar asset for a similar asset. Residential rental for residential rental. Commercial real estate for commercial real estate. Land for land. Can't do commercial real estate and then exchange it for residential real estate. You used to be able to do those same things, machinery for machinery, car for car, airplane for airplane, and so on and so forth. Not allowed to do it. So that takes into account careful planning, and you might be in a situation, and we're going to have some clients that are in this situation, where that leads to a POW when you get rid of a vehicle, because if you have traded in a vehicle a number of times in the past, and we're talking about for your business, you now are going to have to recapture, under normal circumstances, all of the prior year gains that were then deferred and included in the new basis of the new vehicle. So what does that mean? So let's say 5 years ago you bought a business vehicle for $50,000. You held it for 3 years and basically you traded it in for $25,000 for now a $75,000 vehicle. Don't get caught up on the numbers, just know this. Whatever that next vehicle was bought for, whatever the gain is, you're going to now reduce that basis. If you still don't follow what I'm saying, well, now you're in a situation, you bought one for 50, you bought another one for 75, you exchanged them in, the 75, now you're going to sell it or trade it, it's going to be taxable. So whatever gain you would have had on the first one, whatever gain you would have had on the second one, even though those were both like-kind exchanges, now you're going to have to pay tax on it. And you think, yeah, well, big deal. I mean, if my car's worth 20 and I sell it for 20, it's no gain. That's not how that stuff works. If you bought it for 50 and now it's at a $25,000 value, you may have written off everything. So if you had yourself an SUV that you bought for 50 grand back in the day, you most likely wrote off almost all of it, or over a period of time you would have gotten most of that as a write-off. So even though it's worth $25,000, that is the fair market value. That is not necessarily the tax basis. The tax basis is what you bought it for minus the depreciation. So follow me on this. You buy something for 50 grand, it's worth 25, but you wrote all of it off for tax purposes. Your basis is zero on that $50,000 vehicle. If you wrote it all off, your basis is zero. So when you trade it in for a $25,000 value, you have a $25,000 gain. Doesn't matter that the vehicle's worth 25, it's that your basis is zero, you traded it for 25,000, you have a $25,000 gain. But in a like-kind exchange, you're in a circumstance where that $25,000 is now included in the basis of the next vehicle bought. So on this example, you buy the next one for $75,000. You bought it for 75, right? No two ways about it. Now you traded in that vehicle. Regardless of that, you have a $25,000 gain, so the basis in the new vehicle is $50,000 because you're going to have to take the 75 purchase price and then subtract out the gain, and now you're writing off 50. So think of this, you bought it for 75, but your basis for tax purposes is 50. Let's say you wrote all of that off. Follow me, stay with me. Here comes the big part in a second. You now write off all of that. So your basis in the next one becomes zero. So So now you're in a situation where you go from 75 to 0 a lot quicker because immediately you had to reduce the basis down by 25,000 from the gain. You write all that off. Now you're going into the third vehicle. You go, well, hey, I'm just going to get another $75,000 vehicle. You know, it's kind of a wash in the sense that I got a 75, I'm going to trade it for a 75. Great, but your basis is 0. So when you go to trade it, doesn't matter if you trade it or sell it, you're now going to have a gain. So what's that vehicle worth? You bought it for 75, now it's worth 40. Your tax basis is 0. So when you go now to trade it or sell it, it's a taxable transaction. You can trade it, it's still taxable. To what extent? The trade-in value, tax basis 0, be a $40,000 gain. So think about this. If you sell it, you're going to have a gain. That would be the case whether old law or new law. But now when you go trade it in, whatever value you're given on the trade-in, that's going to indicate your gain. Are you listening? So when you're now negotiating and you want yourself to get a good trade-in, think of how this is going to work. Man, and I hope you paid attention all the way till now. Because here is where I'm giving you a huge tip. When you now go in to trade that vehicle under the new law, again, this is a vehicle that you're using in a business that you have written off. Now you go in and you go, I want $40,000 for this vehicle. It's in prime shape. Well, if Kelley Blue Book or whatever is indicating that it could be a range from 34 to 40, let it trade in for 34, but then where you're going to negotiate, listen, where you're going to negotiate is on that sales price. And this is where you're going to beat the hell out of that salesperson. And they are going to end up in the same circumstance. But a car salesman may not get it because they get the commission on what they're selling. They're not going to get a commission on what that dealership's going to buy. So think of this. You now are going to go buy yourself another $75,000 MSRP. And maybe they've already put it on sale. What you're going to beat the hell out of it on is if you're now going to take a trade-in value of $34,000 when it could be $40,000, you're going to take a $6,000 less trade-in value. Then you want to make sure whatever you're buying that new vehicle for, that it's $6,000 less. I get it 6 1/2 dozen the other when it goes to the bottom line. Do not let that finance manager get you whirling in a circle and getting your head spinning and going, well, it just doesn't matter. This is all going to come out the same. Wrong. Wrong. You put yourself in a situation, you say, you know what, either I'm walking out or I'm calling my CPA, because what the deal is that whatever that trade-in value is, whatever the trade-in value is, compared to your basis, and in this example, it's 0, that is your gain. So if they put you in a situation where they're going to put the 34, they're playing ball, then you need to make sure that whatever you're purchasing it for is $6,000 less in this example. What they're going to want to do is say, man, we're so good to you. Look at this trade-in. We're going to give you $40,000 for this vehicle. Why are they doing that? Think about it. Because they get to then have a higher sales price on the new vehicle that you're buying, whether it's new or used, the new vehicle as in the one that you're buying. That's how they're making their commission. And I'm not saying that a car salesman's playing games or doing something fraudulent or doing something that they should have. This is not the norm. Most people want to walk in and they want more trade-in and then they don't pay attention to the MSRP. You got to do the opposite. Don't follow what I'm saying. Get a hold of your CPA and say, listen, under the new law, I know that whatever I trade this in for, I'm going to have a gain. There's no more like-kind exchange. What is it that I should do? If you don't have a CPA, get one. Then if you really are in dire straits because it's Saturday and for whatever reason, there's no way you can wait till Monday to get that vehicle. You're going to die at midnight on Saturday if you don't have that vehicle on a Saturday. Here's where you're going to focus in. This is it right here. Your trade-in value, you want it to be lower. You want your sales price of what you're buying to be lower. Think of this, lower, 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 lower. What you're trading in, get a lower amount so that the sales price of what you're buying is a lower amount. It is all $6,000, comes out to the same net. All right, hey, thanks for tuning in. Thanks for letting me bark at you, but why am I barking? Because I'm looking out for you. That's what JJ the CPA does. All right, hey, if you love my videos, I hope you do. I'd love it if you'd subscribe, and then don't you ever forget, you've never met a CPA quite like me. Don't you ever forget,
You've never met a CPA quite like me.